Welcome to the Research Desk. The year is 2026, and the landscape of systemic alpha generation requires our immediate, unvarnished attention. We are analyzing the state of arbitrage, specifically examining a central tension that dictates modern capital allocation. Does arbitrage continue to deliver genuine, diversifying alpha, or has what the industry labels as arbitrage systematically devolved into disguised, highly leveraged short volatility and short liquidity risk, a structure engineered to generate steady returns in calm waters, only to fail spectacularly during periods of market stress? We are examining an investment strategy that currently sits directly at the fault line between market efficiency and market fragility.
The core issue we must resolve today is, frankly, a structural misclassification of risk. Allocators are pouring institutional capital into what the financial industry aggressively markets as arbitrage. However, a rigorous decomposition of these returns reveals a much darker reality.
Yeah, a much darker reality for sure.
Exactly. The vast majority of these strategies are merely warehousing hidden risk. They're executing the financial equivalent of collecting pennies in front of a steamroller. They extract a steady, incremental yield by standing directly in the path of tail risk events. The strategy appears flawless until a correlation break or a sudden funding squeeze invariably destroys the balance sheet. The premise of riskless spread capture in modern markets is a dangerous fiction.
Well, I completely reject the premise that modern arbitrage is a fiction. I mean, we can establish common ground immediately. The classical concept of a completely free lunch is gone.
Completely gone.
Right. The obvious riskless parity trades, the textbook examples of buying gold in London and selling it simultaneously in New York for a guaranteed profit, those have been entirely automated away. But genuine arbitrage has not died. It is simply migrated.
Migrated how, exactly?
It now operates within highly complex, capacity-constrained, and intentionally opaque relative value trades across our modern market architecture. The opportunity set remains incredibly robust, provided the capital structure is built to process complex information and withstand institutional friction.
To effectively evaluate your claim about this supposed migration, we really have to establish the baseline facts regarding the automation of parity. Classic textbook arbitrage is definitively dead in public equities and liquid futures.
Yes, absolutely.
Machine speed liquidity provision has systematically compressed simple price discrepancy windows from minutes down to microseconds. The algorithms have eliminated the easy spread. We do not disagree there. But you are attempting to rebrand fundamental risk-taking as arbitrage.
It is not a rebrand, though. It is an evolution of the hunting ground. The empirical data entirely supports the death of the simple equity spread, which is exactly why capital has structurally shifted toward derivatives.
I see.
We must look at the structural expansion of options trading to understand where capital is currently deployed. Average daily options volume hit a staggering 46.1 million contracts in 2023, and I want to emphasize the scale of that shift. Compare that 46.1 million to merely 18.2 million contracts just 5 years earlier in 2018.
That is a massive jump.
It really is. That explosive volume growth is not a retail anomaly. It represents a fundamental rewiring of market plumbing. Modern spread capture now lives across strike prices, expiration dates, dealer positioning, and exchange-traded fund baskets driven by this exact derivatives volume.
Before we dive into the mechanics of those 46.1 million contracts, the theoretical framework governing this entire evolution is critical. You are relying on the Grossman-Stiglitz paradox.
Naturally.
For those allocating capital, this is the foundational academic theory which dictates that if markets were perfectly efficient, prices would instantly reflect all available information. Consequently, no market participant would ever spend capital, time, or computational resources to gather information.
Right, because there would be no edge.
Exactly. Because information gathering is highly costly, markets must retain some structural degree of inefficiency to compensate the participants doing the work. Therefore, perfect efficiency is theoretically impossible. You are using Grossman-Stiglitz to claim that these inefficiencies must exist in the options market.
Exactly. Grossman-Stiglitz mathematically guarantees that dislocations must exist. It provides the mandate for the modern arbitrager. If the market were perfectly efficient, the algorithms would have nothing to correct.
But the Schleifer-Vishny framework governs the lived reality of the capital allocator. Their framework regarding the limits to arbitrage proves that identifying an inefficiency is entirely secondary to surviving the friction of convergence.
Secondary? How so?
Let us translate that into practical terms. If you identify a mathematical mispricing, but your prime broker issues a margin call and forces you to liquidate your position during a period of severe market stress, well, the underlying inefficiency you discovered is utterly irrelevant. A market can remain irrational much longer than your balance sheet can remain solvent.
That is a fair structural constraint. But sophisticated arbitrageurs build capital structures specifically designed to withstand that exact friction.
History aggressively suggests otherwise. The historical record provides the definitive case study on the limits of survival. We must examine long-term capital management in September 1998. It is the quintessential lesson in this structural failure.
LTCM was managed by Nobel laureates, though. Their models were considered the absolute apex of financial engineering at the time.
And yet, they failed spectacularly. Let us dissect exactly what happened. The fund built core convergence positions in sovereign bonds and related fixed income instruments. They identified mathematically sound, but exceptionally small, price spreads between highly liquid benchmark treasuries.
The newly issued on-the-run bonds.
Yes, and the slightly older, less liquid, off-the-run bonds. Because the two bonds were essentially identical obligations of the United States government. Economic logic dictated their yields had to eventually match, but because the price differences were microscopic, LTCM required massive, unprecedented leverage to generate their target returns.
Right. They operated with absolute mathematical confidence that these historical relationships would revert to the mean. But their models assumed a normal distribution of market events.
Precisely. They did not account for August 1998, when the Russian government abruptly defaulted on its sovereign debt. That was the exogenous shock. A sovereign nation simply refusing to pay its obligations completely broke the fundamental assumptions programmed into LTCM's machines.
The Russian default initiated a violent global flight to liquidity. Institutional investors panicked. They immediately sold anything slightly illiquid.
Like the off-the-run bonds LTCM owned.
Exactly, and blindly bought the absolute safest, most liquid assets available, which were the on-the-run treasuries LTCM was shorting. The spreads that LTCM's pristine models guaranteed would converge instead widened violently.
Consequently, the banks financing LTCM's massive leverage panicked simultaneously. Funding tightened overnight, mark-to-market losses rapidly outran the fund's available capital, completely destroying their ability to survive the margin calls.
The sheer scale of the fragility was breathtaking. The cascading failure required a roughly $3.6 billion private sector rescue, explicitly organized under intense pressure from the Federal Reserve inside their New York offices, strictly to prevent systemic contagion across the global banking sector.
And that brings us to the ultimate lesson of LTCM, which remains the absolute governing law of modern relative value. The mathematical spread was eventually proven entirely right. The bonds did ultimately converge.
But the balance sheet died before convergence could arrive.
Exactly. Textbook arbitrage failed the ultimate survival test in 1998. Combine that structural fragility with the fact that machine speed algorithms have subsequently killed the remaining easy spreads, and you see why I'm deeply skeptical of anyone claiming to run pure arbitrage today.
I concede the lesson of 1998. If you rely on extreme leverage to harvest microscopic public market spreads, you will eventually be carried out on a stretcher. Since the simple parity trade is extinct, I will precisely define where surviving alpha lives today.
I am all ears.
My case rests on the premise that arbitrage has migrated into complex systems. There are 4 foundational pillars supporting modern arbitrage: market structure, asset concentration, derivatives expansion, and informational friction.
I am highly skeptical of this migration theory. Let us dissect your first pillar, market structure.
The very algorithms that destroyed old arbitrage created a completely new ecology of micro-opportunities. We observe transient dislocations appearing and disappearing at machine timescales. These are driven by structural mechanics.
Mechanics like order flow imbalances?
Yes, order flow imbalances, execution delays, and the temporary inventory pressures faced by automated liquidity providers. Consider the mechanics of exchange-traded funds. When a massive institutional order hits an ETF, the price of the ETF briefly detaches from the underlying basket of stocks it represents.
Right.
Authorized participants step in, buy the underlying stocks, exchange them for ETF shares, and pocket the difference, snapping the price back into alignment. Extracting spread from these transient misalignments is economically meaningful, risk-mitigated arbitrage.
I disagree with the classification. What you are describing is not arbitrage, it is transient execution edge. It is highly dependent on latency and massive infrastructure spend. You are not finding alpha.
I think you're underestimating the structural necessity.
You are just renting a microwave tower to transmit data 1 millisecond faster than the firm across the street. That is an infrastructure arms race, not an investment strategy.
The infrastructure is merely the tool required to harvest the inefficiency. The inefficiency itself is real. But let us move to the second pillar, which addresses structural concentration. Consider the contemporary equity market, where 7 megacap technology names entirely dominate major indices and active risk budgets.
That intense concentration engineers a dense, interconnected web of relationships.
Exactly. Spanning single stocks, index futures, sector ETFs, structured products, and option surfaces. A major technology stock becomes temporarily expensive today, not due to company-specific fundamental valuation, but because passive index trackers, options dealers dynamically hedging their gamma exposure, and ETF-authorized participants all systematically demand the underlying shares at the exact same moment.
You are describing a top-heavy market environment ripe for catastrophic, localized distortions.
Yes, and those distortions are the opportunity. The modern opportunity is not buying a physical stock in New York and selling it in London. The opportunity is exploiting the temporary, structural misalignment between the underlying equity, its derivative surface, the sector ETF, and the benchmark index basket.
Which brings us directly to your third pillar, relying entirely on the derivatives data we established earlier.
Yes, that explosion to 46.1 million daily options contracts creates persistent, structural, relative value opportunities. Sophisticated funds now track the spread between implied volatility, what the options market predicts will happen, and realized volatility, what actually happens.
They hunt for skew dislocations?
Exactly. Skewed dislocations across different strike prices, term structure anomalies across varying maturity dates, and highly complex basis trades between underlying cash products and derivative overlays. This volatility arbitrage is deeply structurally embedded in modern market plumbing.
I am going to vigorously challenge the true nature of that volatility premium shortly because I believe it is fundamentally misunderstood. But outline your fourth pillar first.
The fourth pillar is informational friction. Alpha in 2026 relies heavily on superior underwriting in intentionally opaque markets like private credit, specialized asset-backed lending, and distressed debt, where public disclosure is uneven, where legal documentation is bespoke and highly negotiated, and where collateral structures are deliberately obscure.
The investor wielding the superior information processing apparatus captures a persistent premium.
Precisely.
Now you are expanding the definition of arbitrage to encompass fundamental credit underwriting. Analyzing a bespoke legal contract to determine if a distressed company will default is classic fundamental analysis.
It is reducing uncertainty.
It requires taking severe directional credit risk. Calling that arbitrage is intellectually dishonest.
I am defining arbitrage by its modern function, which is systematically reducing uncertainty in high-friction environments. We must conceptualize this evolution using the transition from silent film to modern cinema.
Silent film to cinema?
Yes. Suggesting that arbitrage has not evolved simply because both historical and modern iterations involve exploiting price differences is fundamentally flawed. It is identical to claiming cinema never changed because both silent films and modern streaming dramas involve moving pictures on a screen. The medium, the speed of execution, and the narrative complexity have utterly transformed, even as the core essence of the discipline remains completely intact.
That is a clever framing, but the transformation in speed and complexity introduces entirely new categories of catastrophic risk that classical arbitrageurs never faced.
Compare old physical arbitrage to a classic caper film. The historical arbitrager raced physical distance on trains before information could travel across telegraph wires. Today, modern arbitrage races competing algorithms at the speed of light.
The speed fundamentally changes the risk.
Furthermore, the governing analogy for the 2026 landscape is thermodynamics. Modern financial markets operate as high-entropy systems. They naturally trend toward chaos and disorder. The persistent opportunity, the modern alpha, strictly belongs to the participant who expends the maximum energy, computational power, legal structuring, infrastructure, to reduce uncertainty and create order within that system.
Reducing uncertainty through massive effort is fundamentally different from executing a riskless parity trade.
To illustrate how this migration occurs in practice, we have to examine the early cryptocurrency exchange landscape of 2017. It presented the absolute purest modern replication of historical textbook arbitrage. We observed Bitcoin trading at exactly $5,000 on the United States-based exchange Coinbase,
while simultaneously trading at $5,500 on the South Korean exchange Bitham.
Yes, a glaring 10 to 15% structural gap on the exact same digital asset.
The ultimate free lunch, right?
Right. But the problem existed entirely in the implementation. This massive spread persisted because fiat currency transfer rails, extreme capital controls enforced by the South Korean government, intense regulatory uncertainty, and sheer operational friction prevented instant convergence.
So you couldn't actually complete the loop.
Exactly. A trader could easily buy the cheap Bitcoin in the US and send it to South Korea in minutes. But once they sold it for South Korean won, they could not legally or efficiently wire the fiat currency back to the U.S. banking system to repeat the loop.
Institutional capital could not instantly move dollars to collapse the premium.
However, as institutional infrastructure eventually improved and specialized capital entered the ecosystem, that 10% to 15% free lunch systematically vanished.
The fundamental mispricing was ultimately arbitraged away by the arrival of efficient infrastructure. I agree with that mechanism.
But here is my central point. The capital did not leave the ecosystem once the simple spread vanished. The opportunity migrated. It shifted immediately into complex funding rate differentials in perpetual futures and highly structured cross-venue basis trades.
It just mutated.
Yes, and without modern arbitrageurs constantly absorbing these temporary imbalances, the combination of aggressive retail flows and private market opacity would consistently generate catastrophic, persistent market distortions. The financial system fundamentally requires this capital to function.
Well, I systematically reject the bull case. Your thermodynamic framework and your cinema metaphors are largely marketing euphemisms deployed by hedge funds to justify charging exorbitant management fees. What capital allocators currently label as sophisticated arbitrage often embeds deep narrative fragility.
Narrative fragility.
Yes, and it is entirely dependent on the incredibly dangerous practice of warehousing hidden risk.
You keep using that phrase. I want you to define the exact, specific, hidden risks you observe in the market right now.
The primary threat is hidden common factor exposure, specifically within the mega-cap technology concentration you cited as your second pillar. Statistical arbitrage funds routinely construct complex pair trades,
Going long one technology asset and shorting another.
exactly based on historical price relationships. Outwardly to their investors, they project the mathematical illusion of a perfectly market-neutral diversified portfolio. However, rigorous decomposition proves these books are quietly loaded on the exact same macroeconomic factors.
They are taking the same beta.
Precisely. Two mega-cap tech names may display slight valuation dispersion on paper, but both positions are fundamentally expressions of the exact same underlying exposures: extreme duration sensitivity to interest rates, artificial intelligence capital expenditure enthusiasm, benchmark index concentration constraints, and identical dealer flow dynamics.
So your argument is that the idiosyncratic, localized spread they believe they are capturing is actually just a disguised macro beta trade.
Exactly, and when you mislabel a massive macro beta trade as relative value alpha, you invite systemic failure. When interest rates shift unexpectedly, both sides of that pair trade collapse simultaneously. The second critical issue is the systemic mislabeling of volatility strategies.
You mean the 46.1 million options contracts?
Yes. You cited that explosion as a structural opportunity to capture the spread between implied and realized volatility. I argue that persistent gaps between implied and realized volatility are rarely true inefficiencies waiting to be corrected. They are almost exclusively compensation for selling insurance against catastrophic tail events.
You view the entirety of volatility arbitrage as nothing more than an insurance underwriting business?
The insurance underwriting analogy is absolute and fundamental to understanding modern markets. Many so-called volatility arbitrage funds are not solving magic mispricings on the option surface.
Right.
They operate identically to property insurance businesses pretending to be complex mathematical equations. They sell options, collecting steady premium month after month. They print incredibly smooth returns, completely ignoring the underlying risk, until a systemic hurricane arrives and permanently wipes out the capital base.
They are structurally short convexity.
Exactly. When markets crash, volatility explodes, and the insurance payout they owe bankrupts the fund.
I have to push back hard there. If a fund effectively models the historical frequency and the potential severity of the hurricane and prices the options accordingly, collecting the premium is a mathematically sound, legitimate strategy. Insurance companies are highly profitable businesses.
They are profitable until the third major problem, structural crowding, destroys the exit liquidity. You cannot model a hurricane if the hurricane is caused by the other insurance companies all trying to evacuate through the same door at the exact same time.
You are referring to the August 2007 quant quake.
Yes, it perfectly illustrates the lethality of crowding. The setup was a massive deployment of institutional capital into statistical arbitrage funds running ostensibly diversified market-neutral long-short portfolios.
The fundamental issue in 2007 centered on deeply flawed risk management assumptions across the industry.
Yes, the models assumed weak cross-fund coupling. Every portfolio manager believed their specific portfolio constructions were uniquely idiosyncratic and proprietary. Instead, they discovered the terrifying reality that every major quantitative fund owned slight variations of the exact same cheap versus expensive fundamental factors.
They all bought the same value stocks and shorted the same momentum stocks.
Furthermore, they were all financed identically by the exact same prime brokerages and governed by identical value-at-risk risk limits.
So when the volatility hit, we saw unprecedented disruption in supposed market-neutral strategies.
We witnessed violent, highly correlated unwinds over a matter of days. When one massive fund began deleveraging due to initial subprime mortgage stress, their forced selling pushed prices against the wider quantitative community.
That price action immediately triggered the automated stop losses of the next fund.
Exactly. What looked on paper like pure, uncorrelated relative value arbitrage was abruptly revealed to be a massive, shared liquidity position.
The 2007 quant quake clearly demonstrates model fragility. The machines did not understand that their own actions were causing the market impact, which leads directly to your next point.
Model fragility in highly automated markets is a severe systemic vulnerability. Relationships that appear completely stable in pristine historical backtests fail instantly when market microstructure changes or when options dealer inventory positioning abruptly flips from long to short. Furthermore, you must account for the fifth problem: funding mismatches and implementation friction.
True convergence depends heavily on external institutional policy, not merely on the mathematical output of a pricing model. Give me a specific structural example where external policy completely superseded mathematical pricing.
We must analyze the proposed Pfizer-Allergan corporate merger. The merger arbitrage spread, buying the target company and shorting the acquiring company, looked mechanistically attractive.
It was fundamentally secure based strictly on valuation logic and decades of historical deal closure rates.
Arbitrageurs poured billions into the spread. However, the spread was entirely destroyed by rapid, highly targeted political and regulatory intervention regarding corporate tax inversion policies. The U.S. Treasury effectively changed the rules overnight to stop the deal.
Wow.
The mathematical probability of convergence was rendered absolute zero by the state. This proves conclusively that implementation friction dictates harvestability. A pricing model cannot perfectly predict political intervention.
I acknowledge the Pfizer allergen example as a clear limitation of models. We must synthesize these structural realities. If my framework, identifying transient, structural micro-opportunities, exists simultaneously with your framework, identifying catastrophic, hidden tail risks, the true mandate for the allocator in 2026 is identifying how institutional capital survives the direct intersection of these two massive forces.
The true wildcard for allocators is the analytical ability to distinguish genuine arbitrage alpha, which stems from idiosyncratic, highly repeatable market frictions, from pure liquidity insurance premium,
which is merely compensation for standing blindly in front of impending disorder. This requires entirely distinct capital allocation models depending on the environment.
Consider the supply chain bottleneck analogy. A specific market spread can be economically and mathematically correct, yet remain entirely operationally impossible to execute. It functions exactly like a manufacturing factory that possesses massive, proven consumer demand for its product, but suffers from zero logistical throughput due to a broken physical supply chain.
The bridge is out.
Exactly. The opportunity exists clearly on the balance sheet, but the physical reality prevents the monetization of the asset.
That friction is highest in private markets. And in private markets where informational friction is paramount, the governing dynamic is the fog of war analogy. The institutional edge does not come from miraculously finding a completely different battlefield that no one else sees. The true edge comes from looking at the exact same opaque, chaotic battlefield as your competitors, but processing the incoming data more clearly, underwriting the structural risk more accurately, and executing with superior capital duration.
Capital duration, the ability to lock up investor money so they cannot panic when withdraw it during a drawdown, is the ultimate determinant of success.
We observed this duration dynamic flawlessly executed during the 2008 crisis distressed credit environment. The setup involved incredibly complex, highly distressed residential mortgage-backed securities trading at severe, unprecedented discounts. Institutional investors armed with deep legal expertise and strictly patient, locked-up capital aggressively bought these complex securities at extreme pennies on the dollar.
But the core tension there was not informational asymmetry regarding the underlying asset quality. Everyone knew the housing market was collapsing.
Precisely. Competing investors held the exact same macroeconomic views and identical valuation models regarding the underlying real estate collateral. The difference was entirely structural. The competing funds that failed relied on weaker, short-term financing structures subject to immediate daily margin calls from their prime brokers.
The ultimate outcome validates Schleifer-Vishny's limits to arbitrage. Only the well-financed, structurally secure entities survived the massive volatility to realize the underlying investment thesis. The capital structure itself is the core alpha process. If you have daily liquidity in a distressed debt fund, you do not have an arbitrage strategy, you have a suicide pact.
Conversely, the public machine speed environment presents an entirely different survival test.
We examined the May 6, 2010 flash crash for that test. The setup involved machine speed algorithms reacting aggressively to a large fundamental sell order in the futures market, which rapidly amplified into a self-reinforcing cascade of selling. Liquidity instantly evaporated across the limit order book.
This caused prominent blue-chip stocks to trade at absurd, fundamentally detached prices, some dropping to a single penny per share, others spiking to over $100,000.
The tension centers squarely on the theoretical opportunity versus the practical execution. During those few minutes, apparent arbitrage opportunities massively exploded across the market tape. The spreads were mathematically enormous.
But the structural market quality was utterly unreliable.
Exactly. The machine speed market architecture created the temporary dislocation, yet simultaneously made execution completely hazardous. Bids were routed into a void, hedges failed to execute, the market data itself was delayed. The system demonstrated that extreme opportunity and extreme fragility arrive at the exact same millisecond.
We have firmly established the fault lines between efficiency and fragility. We must now translate this synthesis into authoritative, specific portfolio architecture. We will step through the tactical playbook for capital allocators in 2026.
We will deliver the precise structural recommendations required to navigate this landscape.
Recommendation 1 addresses absolute sizing parameters for institutional portfolios.
Allocators must treat modern arbitrage strictly as a specialized diversifier, never as a core cash substitute. We target a strict 5% to 10% total portfolio allocation to relative value and specialized alternative funds. This requires stringent discipline. Slipping beyond 10% introduces systemic liquidity risk to the broader portfolio. Furthermore, an aggressive 10% overweight to specialized alternative asset funds, specifically focusing on private credit and distressed debt, is actionable over a defined 3-year horizon. However, this must be classified strictly as risk capital. It is not, under any circumstances, to be modeled as safe alpha or a fixed income replacement.
Recommendation 2 targets the exploitation of the informational frictions we discussed. We justify a precise 7% allocation within the broader alternatives bucket directly to specialized private credit funds.
And these funds must explicitly demonstrate strong, quantitative macroeconomic integration within their credit underwriting process.
Yes, we target an 18 to 24 months deployment horizon to capture the current distress cycle.
The risk management overlay is absolutely critical here. How do we protect that 7%?
We mandate a strict mathematical risk parameter. Allocators must automatically reduce this 7% allocation by exactly half if macroeconomic uncertainty spikes sharply or if underlying institutional funding costs jump materially. You do not wait for the corporate defaults to occur. You reduce exposure the moment the macroeconomic financing architecture weakens.
Recommendation 3 mandates explicit stress testing of mega-cap technology exposure to combat the hidden factor risk you identified. We require an explicit factor decomposition rule for all quantitative equity strategies. We set a hard mathematical trigger.
If the 30-day rolling correlation among the top 5 mega-cap technology names falls below 0.6.
Exactly. The allocator must force the manager to cut gross exposure by exactly 50%. The book must remain deleveraged until the fundamental factor risks are entirely re-underwritten and proven to be idiosyncratic.
Recommendation 4 directly addresses the systemic risk of volatility as insurance. We reiterate the sheer scale of the structural risk. 46.1 million daily options contracts in 2023 versus just 18.2 million in 2018.
It is a staggering jump.
This massive volume creates a gigantic, hidden, short volatility complex. Allocators must fundamentally classify all volatility arbitrage strategies as insurance-selling businesses, unless the quantitative managers can explicitly prove robust convexity through rigorous historical stress tests.
You must rigorously verify the structural integrity of the financing.
You must strictly cap leverage and aggressively interrogate the underlying financing terms to actively avoid the long-term capital management failure mode. Allocators must force managers to answer the brutal, fundamental question.
What specific systemic pain is this fund being paid to absorb?
Yes. If the strategy cannot clearly articulate the exact risk it is warehousing, the strategy is defective.
We reach our final synthesis. The traditional free lunch of arbitrage is definitively gone. The bill for extracting alpha in 2026 inevitably arrives through complex leverage structures, transient liquidity constraints, and systemic model error. Structural inefficiencies absolutely continue to exist across expanding derivative surfaces and within opaque, document-heavy private markets. However, the paramount systemic danger remains the dangerous practice of unknowingly warehousing hidden macroeconomic factors under the guise of relative value arbitrage.
The real divide is no longer between those who can price the spread and those who cannot. It is between those who can survive the path and those who cannot.
This is the research desk officially signing off.